Okay, morning class. So it's been a while since we, started with the classes. Now here we are going to talk about the last topic in stock market. Okay, the last topic in the second chapter. All right. So which is your derivative? If you have heard about the derivative earlier, it is very good. Since I can't have a provision to make you people answer, it's better that you listen. Okay, immediately after this lecture you would have certain MCQs. So when you view this video, attendance would be marked, especially in the YouTube video, because we have a provision from the college end which marks attendance of those people who are viewing it, okay, and for how long they're viewing, and in the end those who fulfill the criteria of watching the video for the entire duration, only they'll get the attendance. So you can neither fast forward, your attendance will not be recorded. So we have a very cunning tool for it. So please try to be there for the class, and in order to answer the MCQs rightly, which counts for your internals, you need to know what is the video all about. Okay, so let's start. So the last topic that we are going to deal with is derivatives. So derivative is normally we say it is something whose value is derived from. You derive a value. Okay, so with the same logic, that is the general meaning of a word called derivative. But derivative as an instrument tells a financial instrument whose value is based on or value is derived from one or more underlying asset. Now, this is a financial instrument. Okay, this is a financial instrument, and there is a reason why it is being traded. All right. For example, uh, I am a business person. All right, and I need some cotton. All right, I need some cotton, and you guys are the sellers who would you are the seller who is offering to sell the asset, which is cotton. All right, so what do? I need the cotton for production next month. Right now the price of cotton per ton is say 400 rupees, for example. Okay, you are aware of the market price as the seller, I am aware of the market price as the buyer. I know it is going to be 400, but every day the price is increasing. So what we predict is next month the price is going to be 600. All right, and I need this cotton only next month, or I have the fund to buy this cotton only next month. So there's no point if you sell it this month. Okay, so what do? I ask you, okay, I tell you that sir, listen, I need to buy cotton from you, but right now the price is 400, later it's going to be 600. I don't have the money to buy now, but I can buy it from you only on a specific date next month. Okay, we both are aware that prices are going to go from 400 to 600. So I want to enter into a contract with you which says that you will be selling cotton to me next month, okay, on say 25th of April at rupees 400, even though the market price is at 600. All right. So what will the person say? He would tell you, he might, negotiate, you might negotiate, and ultimately he might say, okay, I can sell you at 500. So, and you, if when me as the buyer, even I am okay with your price. When the buyer and seller has negotiated and found out that this thing can be sold at this price, specified price on a specific date, no matter what is the market price, we call it a derivative. Okay, so that cotton, okay, that cotton is called as the underlying asset. Okay, and the agreement or the contract which says that I am going to buy or you are going to sell me this product on 25th of April at rupees 500 is the financial instrument or contract. We call this financial instrument or contract as derivative. Is it clear to you? So this is just an example. You can go through this example. It's a better and easier way to understand. Now this underlying asset, like it said, can be a share, can be a stock market index, can be a commodity like cotton, or an interest rate, or a currency. Okay. Now they say when the price of the asset changes, okay, the value of the derivative may also change. There might be some agreement between the buyer and seller saying, okay, I will give you at 500 only if the price is above 499 in the next month. Only then I can sell you at 500. Okay, if it is within the range of 400 and 499, I'm happy to sell you at 500. But on other conditions, the contracts are very much customized. They can make their own contracts. Some of them are very much legal and regulated or organized. The other one is not. Okay, we'll learn about the different types, you'll understand. So when the seller says, okay, if the price goes only till 499, I am ready to sell at 500. But if the price of the market price of the asset goes 500 and beyond, you will have to give me 600 rupees as per the market price. So these are the conditions wherein the price of the asset has an important effect on the value of derivative. Okay, so derivative is basically a contract between two people or three people who agree to buy or sell an asset at a specified price and on a specified future date. Clear? Okay. Derivatives are of two main categories. We have exchange traded derivative, we have OTC traded. Exchange traded derivative, as the name signifies, means those derivatives which are traded in almost all the exchanges. Now the plus point about trading in an exchange is it is very standardized. We have SEBI, we have other authorities within a stock exchange who would see to it that the trade happens. Okay, that is why those derivatives which are standardized and which you would find only in exchanges are called as exchange traded derivative. Now suppose the parties do not want to go to an exchange. They want to do the contract on their own terms and conditions. They don't want anyone to regulate. Okay, in a way we say such contracts are not standardized. So what they do, if they go to the exchange, they have to follow the rules of the exchange. Rather, they would do it on a OTCI method. We have another exchange called Over the Counter Exchange of India, which allows you to place trades on a phone basis. You can negotiate within yourself. You can trade on yourself based on your conditions. Okay, so those derivatives are traded through OTC and not any other exchange, we call it as OTC or over the counter derivative. So exchange traded derivative are traded only at what do I say, exchanges. OTC are normally your option, swap and your forward contract. So without telling you what are the different types, you won't understand. Just understand exchange traded derivatives are those traded derivatives which are traded in an exchange. OTC, those traded in over the counter but not in any of the exchange. Okay, there are three types of participants in derivative. You have hedgers, speculators, arbitrators. Now when you buy something from a market, if there is a brand which offers you lesser price, good quality but lesser price, as a buyer you would always go for the one which has low prices, right? And if suppose you have this product, you want to sell it in the market, in order to make maximum profit, when do you sell it? When you feel that the price of that product is very high. If I sell it right now, people would pay me a higher price. That is when I choose to sell. So your hedgers are basically, in a way, your buyers and sellers who try to understand what is the risk factor associated, and based on it, they trade. Like I mentioned, when I buy cotton from you, okay, at 600 price in the future, that is going to be a risky factor for me. It is happiness for you, but risky for me because I have to pay more, right? So rather, what did I do? I entered into a contract, which means to say that even if 1 month is complete, I can still buy it from you at today's price. Okay, so when there are people who are doing derivative trading only to save themselves from the risk, we call them as hedgers. Clear? Speculators. Speculators are those people who try to bet. They say, okay, let's see what is the market. Suddenly they find that the market is going very high. Okay, market is going very high. For example, day by day, the price of the asset is increasing. For example, you take the case of cotton itself. I am someone who has a lot of cotton with me. When I see the price is going to increase further and further, I'll be like, okay, let me wait for 1 more month. The price is going to go very high. After that 1 month reaches, you feel okay, the price is still going to go up after 3 days. You analyze the market, and this is the understanding you find that the price is going to go higher and higher. So when you try to see to predict the market trend and you try to make a profit out of it, we call it speculation. Your bull, bear, lame duck, stag, everyone comes under speculation or speculators. So hedgers are just for the risk factors, speculators are to create profit, arbitragers. Now what is the third one? For example, if a person plans to sell products in Sri Lanka and India, for example, the price in Sri Lanka, the buying price, like if you want to buy the commodity and sell it somewhere else, when you analyze Indian market and Sri Lankan market might be giving you a lesser price. As a buyer, what do you want? A lesser price. So you go and try to understand what is the difference between the market. You go to Sri Lanka, you find the price is less. In India, the price is more. What do? You buy at a less price from Sri Lanka and you sell at the higher price in Indian market. Okay, so when you compare one market with the other and you see that there's a price difference and you do your activity, that is you buy from the market which offers you a less price and sell it in the market which has a higher price, we call this activity as arbitrage. When you try to take advantage of the price differences in 2 or 3 markets, we call it arbitrage. So hedgers are for understanding the risk of the price, because if market price changes, they have to end up paying more. Those are your hedgers. Speculators, they try to bet like the money is going to go up next month. They are very, what do I say, patient investors in a way, who try to see how is the price going and they concern their activity from it. So if they foresee prices are going to go high, they would not trade. They would aim at that higher price in order to make a greater profit. Arbitragers, those who try to find out what is the price difference 2 or 3 markets, and based on that they trade. Is it clear to you? Okay. Moving on to different types of future derivative contract, we have forward, future, option, and swap. So forward contract, a contract between two persons who plan to buy or sell an asset on a specified date at a specific price. We call it as forward contract. Like how I told that I'll buy the cotton from you next month at so and so price. Those contracts are said to be forward contract. Yes? Okay. Thing about forward contract is I'm entering into a contract with you, which means we both are the parties in this contract. If we want to keep this contract in a customized manner, or we believe that let's execute this contract on our own terms and regulation without involving any other party, we can do it only in forward contract. Okay, so we discussed about different derivatives in the starting slide, right? What are exchange traded? Those derivatives which can be traded only in the exchange, and what is OTC, wherein you can trade it in the over the counter without following any regulation of exchanges. Okay, so if we want to do a contract on our own terms and conditions in a customized form, we would always say to go for forward contract. Okay, because these forward contract are not standardized. You don't need to trade this in an exchange wherein you would have to follow regulation of some exchange authority. Rather, these contracts are traded only in OTC or over the counter, wherein the contract can be executed on our own terms and conditions. Okay, we call them private contracts because the terms, conditions, negotiation, everything is on our own agreement. I hope it is clear to you. Yeah. Now, what are future agreements? Future is an agreement again between two parties to buy and sell a commodity on a future date at a future price, just like a forward contract. But the thing about this is we work on standardization. These contracts cannot be executed on our own terms and conditions. We would have to leave it to the regulatory authority in stock exchange. This means to say, unlike forward contracts, future contracts are traded only on the exchange, not on OTCA. That is why we say that these are more standardized. Futures are standardized more than forward contracts. Clear to you? So what happens here? Here I go to an exchange. Both of us, buyer and seller, go to an exchange to trade our securities. But okay, let's continue. There might be some external disturbances. Please don't mind it. Okay. So when a contract is standardized and we have to go to an exchange to trade in them, unlike forwards, here it is very much standardized. We have to follow the regulation of the exchange authority and SEBI. In such a case, we go for futures contract. So futures are said to be more standardized, very important, than forwards. Okay, so in the Indian foray, we have NSE or the National Stock Exchange leading in conducting the most developed equity derivative market. You have it there. Okay, there are two types of futures. We have commodity futures, financial futures. This has been classified on the basis of underlying asset. That is, commodity futures are futures traded where the underlying asset is a commodity. Okay, we would learn more about commodities in the next unit. So those contracts which are traded in MCX and NCDX are called as commodity futures, multi-commodity exchange and national commodities and derivative exchange. These are your agricultural commodity, metal commodities and all of them. Now we have financial futures. Financial futures, here the underlying asset is a financial instrument or a financial asset. So here those futures which are traded with the underlying asset being interest rate, we call them as interest rate futures. Okay, interest rate futures, short-term interest rate futures happens in the money market, long-term interest rate futures happens in the capital market. So here the underlying asset is always a interest rate. Could be a floating interest rate or fixed interest rate, depends. Okay, stock index futures. So like how you have Nifty 50, wherein we take the stock prices of the best performing 50 stocks or 50 companies, we assess the market value, market capitalization value, and that is our Nifty value. Every day Nifty value changes. So based on those 50 stocks, if there's a change in any one stock, it affects the total marketization value. This total marketization value is called as index or stock index. Your stock index is your Sensex for BSE and Nifty for NSE. So futures wherein the underlying asset is a stock index, we call it stock index futures. Then we have currency futures, which are normally traded in forex market or foreign exchange market. We have learned about exchange rate, which is the rate at which you can exchange one currency for another currency. Okay, if today the price of dollar in terms of rupees is $1 is equal to 70 rupees, and next month it is going to be $1 is equal to 75 rupees, which means to say next month I'll have to pay 75 rupees to get $1. If this is a scenario, what do I do? And if I have to purchase only next month, what do? I enter into a contract with the person who's holding US dollar. I tell him that I'll purchase this commodity from you next month, but not at 75 rupees, but at 70 rupees. Okay, so this exchange rate, wherein I tell you that, for example, I am the buyer, I have rupees with me, you have US dollar with me. I want $1 US, okay, from you. This month it's going to cost me 70 rupees, but next month this $1 is equal to 75 rupees, which means I have to pay you 75 rupees to get that $1. So what do? And I can purchase only next month. So I enter into a contract saying that I'll purchase from you on another day, that is in the future, let's say 25th of April, but at 70 rupees and not at 75 rupees. So when you predetermine the exchange rate and you execute the trade, we call it currency futures. All right. Options. Options is a contract between two parties. Okay. One person, it's a contract between two parties. One person gives the right to the other person. Okay. So party A. Okay. Wait. Party A, party B. Okay. When I give you the right to buy or sell an asset on a future date at a future price, we call it as what? Option. Please remember, a contract wherein there are two parties. One party gives the right to another party to buy or sell an asset on a future date at a future price. Here I mentioned I'm giving you the right. Okay. But I have no, you have no obligation to buy or sell the asset. I am simply giving you a right. Whether you use it or not is your choice. Okay. So when one party gives the right but not the obligation, or not the not obligating anyone to buy or sell, we call it as option. Please understand, I have given you a right to buy or sell. You can choose to buy or sell. I'll just give you the right. Whether you want to use the right or not is your choice. That is called as option. Option is where I have given you the right, but you have the option to either execute the trade or not to execute the trade as per your thing. Okay? Understood? Now, for example, I have, what do I say? I have enough cotton with me. Cotton. Okay? And I enter into a contract with you. I want to sell this cotton. Alright. So what do I tell you? Okay. See, the price of cotton is how much? 40 rupees right now. I'm giving you a right to buy this cotton from me at 30 rupees next month. Okay. Under option contract, I have cotton with me. I'm asking you to buy it from me. You can buy it from me at 30 rupees on 25th of April at 30 rupees per ton. Okay. So here I'm giving you the right to buy it. You can buy it from me. No issue. Alright. But then next month you realize that you don't need this cotton. You have other materials. You don't want to buy it from me. Yes. I cannot go behind you and tell, okay, listen, you told you will buy, you didn't buy, why didn't you buy? I can't force you to enter into that contract. That is, I can't force you to buy that commodity next month. Because I have given you the right, but not the obligation to execute the contract. Whether you want to execute or not is your choice. Clear? Hope it is clear. If you have questions, let me know. So here, if you want the contract, since you have the right, if you want to execute the contract, you can execute. If you don't want it, you don't need to execute. But if you don't execute, I would have a loss issue, right? I would have a problem with it. So what do I tell you? When I enter into a contract with you, at the time of giving you the right, I will ask you to pay me a certain sum of money. Non-refundable certain sum of money. We call that amount as premium. When you have the right but not the obligation to sell or buy next month, you can choose either to execute the contract or not execute the contract. That is your choice. But I would be at a loss. So what do? When I place the contract with you, I'll take an amount from you as security called premium. When you go for a house, you pay them a security deposit, right? When you go for a PG or your hostel, you pay them a security deposit. Why? So that in case you're going out, the owner is safeguarded from by certain amount of money. It is my guarantee sort of thing. That you would execute or not execute is your choice, but a guarantee that something will be done for this contract and I will not be at complete loss. I will take this premium from you, non-refundable. Clear? So that is your premium. Now there are two forms, call option and put option. So call option is an option where I give the right to you to buy the asset on a future date. I just give you the right. Whether you have to buy or not to buy is your choice. Okay. Put option is where I give you the right to sell the asset on a future date. I give you the right but not the obligation to sell the asset on a future date. Whether you want to sell your asset or not sell your asset, that is your choice. Now you understood the difference. Call option is where I give you the right but not the obligation to buy or not to buy an asset. Okay, on a future date. Put option is where I give you the right to sell the asset or a right but not the obligation to sell the asset on a future date. So buying call option works when you as the buyer, you want to benefit from a lesser price. So today's price is 40. If it's going to be 50 tomorrow, you have the right to purchase from me next month. Even though the market price is 50, you can purchase at 40, which means you get your commodity at a lesser price. So any person who enters into a call option, who's been given the right, that person would always try to benefit from less price because you purchase at a discount. So think in that way. But in sell option, when I give you the right to sell an asset to me on a future date, again it is your choice whether you want to sell or not on the future date. You try to sell, you fix the price, so you try to sell on that future date based on the high price. If the market price is, say for example, today the market price of cotton is 40 rupees. Next month is going to be 30 rupees, which means you would you plan to sell it only next month. Okay, today it's 40, but next month it's going to be 30. This is not a good thing for you if you plan to sell it, because you plan to sell it at a higher profit, that is at a higher price. So what do? You tell them, okay, this is the thing. You have to pay, you are ready to sell the product only at 40 rupees even though the market price is 30 rupees next month. Okay, so you as a buyer, you would look at a lower price to execute the contract. If you are the seller in a put option, you would look at a higher price to sell. So this is your call option and put option. I hope this is clear. The last topic is swap. Swap is like how you swap things. If I swap, for example, you have a phone, I have a laptop. I tell you, you give me the phone, I'll give you the laptop. That is swap. Okay, when two parties agree to exchange a contract or exchange any form of cash flow or interest or currency, when you decide to exchange on a future date at a future price or exchange rate, whatever be the thing, we call it swap. Okay, swaps is where you try to, two parties come into an agreement that on 25th of April you are going to give me a laptop and I am going to give you a phone. Easier to understand? Okay. There are two types of swaps. We have interest rate swap and currency swap. Interest rate swap, here the underlying asset is interest rate. Okay. Yeah. Okay. So interest rate swap is a swap between two people. Sorry, I had to take a break, but yeah. Interest rate swap is a swap between two people, wherein, say I belong to India, you belong to US, for instance. And you are a resident residing there, I'm a resident residing here. Now, okay, you want some loan, okay, or let's say in this way, we both are going to enter into a business. We need to bring what? Capital. Enough capital. I'm going to borrow from this Indian bank in my country. That is, I'm going to borrow from SBI, for example. So what do? I go to SBI. I ask them for a loan. I ask them for a loan. Right? They tell, okay, you have to pay an interest rate of 8%. 8%. Yes. You go to 8% is there. Okay. Now, in my country, I have SBI, which gives me 8%. If I want a loan in Indian rupees, I have a foreign bank in my country, which would offer a loan in US dollar, which would credit in the form of US dollar at 10%. Or let's say SBI offers me 8% for Indian currency loan. For the US currency loan, they would give me 4%. 4% is the interest rate for US currency loan. Yes. In your country, you have a branch of SBI. SBI branches are found outside India also. SBI says, okay, if you want a loan in Indian currency, we would charge you 4% interest rate. What was the interest rate in India? It was 8%. But for the SBI, which is there in the US and is ready to give a loan in Indian currency, they would charge you only 4%. Okay. And you have a loan for, you have Standard Chartered Bank, that is a foreign bank. They are saying, okay, if you want a loan in US dollar, you have to pay 8% interest. So in your country, SBI is offering at a loan in Indian currency at 4%. Your Standard Chartered Bank is offering you loan at 8%. Okay. In my country, SBI is offering me a loan in 8% at 8%, and Standard Chartered is offering at 4%. So whichever bank gives lesser rate of interest, I would prefer that. Now this is the thing. Okay. So what do? We enter into a contract. Because you need US dollar, I need Indian rupees. If I take it from my country, it gives me only how much? It gives me 8% interest in order to take the loan. But in your country, if I take the loan from SBI, it gives me 4%. But I can't do it. So what do? I ask you, go to SBI, take loan at 4%. Okay, from SBI, you take loan at 4% for me. Okay, now leave out SBI. Standard Chartered told you, that is in the US, they told that we will offer Standard Chartered at 8% in the US, but this Standard Chartered Bank is offering US currency loan for only 4% in my country. Okay, so so for you, which one is better, to take it at 8% from your country or 4% from my country? 4% is better. And for me, to take SBI, where 4% is my SBI thing and 8%, 8% is given in my country by SBI, 4% given in your country, what do? I tell you, see, since for SBI, the rate is very less in US. You take the loan for me at that particular rate. Now, in order for your loan in US dollar, the rate is very high in your country, but it is kind of less comparatively because it is only 4% for Standard Chartered Bank. So what can I do for you is, I'll take the loan for you in my name at 4%. So here in India, I'm able to take a US dollar loan from Standard Chartered at 4%. There in US, you can take a loan in Indian currency from SBI at 4%. Okay. So for my requirement, you have done. For your requirement, I have done. So what do? On a later date, I will give you that money in US dollar. You give me the money in Indian currency. This is where you try to make a contract where both the people are satisfied on the basis of the interest rate. Yes. Now currency swap is also there in this because we are trading with different currencies. Okay. We also first we looked at difference in interest rate, whichever was better for us, we swapped accordingly. But then if even though you wanted US dollar, you are not ready to take from your country because it offers a higher rate, it gives you a higher rate of interest on loan. You are asking me to take it from my own country, which offers less in US dollar currency. What do? We swap that currency on a future date. So interest rate swap is where interest cash flows are being exchanged on a future date. Currency swap is where currencies along with the principal and interest and all other amounts is being exchanged on a future date. This is your forward future option swap. I've given you a lot of examples. Some might be confusing. If you have any doubts, do let me know. There are certain MCQs after this module. Please attend those. Yes, if you have any questions, any tiny question also, you can ask me. Thank you.